How billionaires avoid taxes legally. Imagine earning billions of dollars and paying less in taxes than your local school teacher or small business owner. For America's richest individuals, this isn't just a dream, it's their reality. Thanks to legal loopholes, complex tax strategies, and an outdated system, billionaires like Elon Musk, Jeff Bezos, Warren Buffett, and Peter Thiel have found ways to keep their tax bills astonishingly low. This isn't tax evasion, this is tax avoidance, and it's completely legal. A groundbreaking investigation by ProPublica revealed how some of the wealthiest people in America pay little or nothing in income taxes. Based on a massive trove of confidential IRS data, this report uncovered powerful strategies that let billionaires reduce or eliminate their tax burdens, even as their fortunes grow. Let's take a deeper look at how billionaires legally avoid paying taxes, often without anyone noticing. Billionaires don't earn money like regular people. The average American receives a paycheck and pays taxes on every dollar earned. But the ultra-wealthy don't rely on salaries. Instead, their fortunes grow through appreciating assets like stocks, businesses, and real estate. As long as they don't sell those assets, they don't owe taxes on them. These are called unrealized gains, and they're not taxable under current U.S. law. So even if a billionaire's net worth increases by billions, they legally owe nothing in income tax, as long as they don't sell anything. When they need cash, they don't sell, they borrow. By taking out massive loans using their stocks or properties as collateral, billionaires can access hundreds of millions of dollars without triggering a taxable event. Since loans aren't considered income, they don't count toward taxes. The interest rates they get are incredibly low, and they can even deduct the interest as a business expense in some cases. This strategy is at the heart of what experts call buy, borrow, die, acquire appreciating assets, borrow against them to fund a luxurious lifestyle, and pass them on to heirs without ever paying income tax. Roth IRAs are retirement accounts designed to help working-class Americans grow their savings, tax-free. But Peter Thiel turned his Roth IRA into a financial powerhouse. By placing early PayPal shares worth pennies into the account, he allowed them to grow to an astonishing $5 billion, all completely tax-free. This strategy relies on access to pre-IPO deals and private investments, something only a handful of people in the world can do. Even when billionaires do report income, they often wipe it away using deductions and tax credits. Charitable donations are one of the most powerful tools for this. Billionaires can donate money, property, or even stock to nonprofit organizations and get massive tax write-offs. Michael Bloomberg used this technique to bring his effective tax rate down to just 3.7% while earning billions. Other deductions like business expenses and foreign tax credits can reduce taxable income even further. When it comes to inheritance, billionaires don't play by the same rules either. Most families face estate taxes when transferring wealth to the next generation, but the rich use trusts to avoid this. A popular option is the Grantor Retained Annuity Trust, or GRAT. These trusts allow billionaires to move appreciating assets to their heirs, while paying little or no gift tax. According to ProPublica, more than half of the 100 richest Americans use specialized trusts to shield their estates from taxes. Another technique involves taking advantage of wash sale loopholes. Normally, if you sell a stock at a loss and buy it back too quickly, you can't use the loss to reduce your taxes. But billionaires and big firms work around this by buying similar but technically different assets that achieve the same result. This creates paper losses they can deduct while still holding nearly identical investments. Billionaires also generate fake losses to offset real income using something called tax loss harvesting. This strategy involves selling investments at a loss just to reduce tax bills. Some use specially structured funds that generate artificial losses while their overall wealth continues to grow. Jeff Yes, a billionaire trader, is one example of someone who has reportedly benefited from this method. Offshore tax shelters aren't just for spy thrillers, they're a real and legal strategy. By placing money in trusts or accounts in tax havens like the Cayman Islands or Bermuda, billionaires can delay or even completely avoid paying U.S. taxes. These complex arrangements are hard to regulate and even harder for the IRS to track. Even basic payroll taxes like Medicare and Social Security can be avoided by the ultra-rich. While regular employees have those taxes deducted from every paycheck, the wealthy often reclassify their income to avoid them. Hedge fund managers, for instance, take profits as investment returns or partnership distributions rather than wages, dodging billions in payroll tax obligations. Finally, when a billionaire dies, a massive loophole kicks in called the step-up in basis. This rule allows heirs to inherit assets at their current market value, not the original purchase price. That means all the gains accumulated over decades are never taxed. It's the final step in the buy, borrow, die strategy, and it helps ensure that billions can be passed down completely tax-free. Everything in this system is legal, and that's the problem. America's tax code is built to favor wealth over work. Regular workers are taxed on income, while the rich are rewarded for holding and borrowing against assets. The result is two tax systems, one for everyday people, and another for those wealthy enough to shape the rules to their advantage. When people say the system is broken, they're wrong. It's working exactly as it was designed, just not for you.